Hey, welcome everyone. Good morning. We'll start our lesson. Today lesson will go through our LO2. As you know me, my name is Anjum Sattar. Please, if you have any question, drop me email anjum@ukversity.co.uk. So before starting, we'll go through the unit content, what we're supposed to learn, and then we'll start our lesson. Okay. So of course, we are doing OTHM level 7 diploma in strategic management and leadership, and we are doing the unit number 7. Unit level is a 7, and unit title is which we're looking financial management. So when we looking financial, it's mean all about the money, dealing with the money, how you manage your resources, effectively financial resources, and the management is a process of designing an environment to achieve your objective. If you're a good manager, you have to think about how you can effectively achieve your objective with less cost, less time, and with good quality. So today lesson first are LO, which is first learning outcome, be able to apply the tools and techniques of cost accounting. So cost accounting means the management accounting. So we will go through the management accounting and costing elements. Those are quite crucial for financial management. So critically analyze the concept and the features, improve the cost accounting in an organization, apply the tools in costing design and costing system, which will go through and recommend improvement of the costing pricing for an organization. Really, the matter of how we can improve different costing method, which we'll discuss. Second lesson, which will go through critically analyze the financial performance. So we go through the financial performance, financial ratio, financial statement that's related to the financial accounting, which we also use in a management perspective. That will be in our discussion in the second lesson. Lesson 3 will go through be evaluate the budgetary process. We'll discuss about budget, type of budget, why budget is important, and budget is a financial plan for future. Then lesson 4, be able to recommend effective long-term and the short-term resources of funding. We'll discuss different types of resources. We'll discuss about the working capital. We look around the liquid resources those can convert into, and we'll discuss about break-even point, how we can use it and manage other things accordingly. And the lesson 5, be able to critically appraise. So we'll go through different appraisal methods like investment appraisal. Those will be in our lesson 5. So each lesson, please, we've been given uh, the indicative contents. We'll go through the costing system, then we'll go through the financial statement, then we'll go through the budgeting, and we'll go through financial resource managing for working capital, and ultimately, and these are the recommended books, please. It's quite good to be, and which you can, and please, these are quite good website and the journal articles on the financial management. Good to follow them to enhance your further understanding. Please, these are all the website is quite relevant. cmanglobal.com, ATHE, and if you look see in companyhouse.gov, where you can find the information about any companies or their statement you can download as well. Those are registered in the UK in the company house. Okay, we'll start now our lesson. Anybody, any question? Those are listening, please. If you have any question, here is my email address, anjum@ukversity.co.uk. I'll try my best to get back to you as soon as possible. So we'll start. Today lesson, be able to apply the tools and technique of cost accounting. So today lesson key indicative content within the command word we have analyze, apply, and recommend. Those we explain how we can separate the information, how we can apply, how we can recommend. Okay, yes, please. Next, we're looking now indicative content cost classification. Will go through different batch costing, standard costing, activity-based costing. That all will be in our discussion. Okay, so what about, always good to be when we start any activity, always good to reflect what I know already about the topic. Oh, have we ever heard about, I learned in my previous qualification, or where I work at the moment, what I know, or what sort of costing method we are using. So that's, oh, do I know fixed cost, variable cost, semi-variable cost. So that will help you so you can reflect yourself. It's good to be. And then we have now is looking critically analyze the concept of costing. So first, when we do costing are the management accounting and the financial. So management accounting is the internal, which we use for internal purposes, and the financial accounting external, like we preparing the financial statement. So management decide the way they present, help management planning and controlling, and look past. And so what is the management accounting is the past and future data. So that's we're looking past what is happening in the past, what we are going to look around in future. Not legally required to prepare, and we can include both financial and non-financial. We can look around the legal requirement for the limited companies prepare. Look at the past data, usually include the financial information, which we can, and usually include the financial information only. So these are the things really we need to look around to achieve the desired objective of organization that will help, so we need to be look around in the perspective. Okay, so that's, we need to, let's move to the next. Then if we look in term of the financial, so cost accounting, what is meant by cost accounting? So it's help to achieve the purpose of planning where we are, where you want to, and control is a corrective action. We are staying within that cost, within that quality. So that's your control. Decision making means selecting the best option which costs you less. Like we can either we manufacture it ourselves, we buy from. So we can look around the cost per unit. Like car manufacturing want to determine the cost of each car. Yes, different component we can do the costing. In the printing firm we can look around the cost, could be the specific customer order and pen. So we can look around in different organization, we can apply the costing. So accounting firm want to know the cost incurred each client if we are providing service organization. So we can look around the costing in terms of the service perspective. Hospital in a hospital like NHS, we can look around the per patient, per bed, per meal, per service, per hour doctor. So these are the costing which we can look around. Okay, so please, when we look the costing, we can differentiate the type of material cost, how much material required, how much, if we are manufacturing something, how much is the labor required. So the how much is the material, how much is the labor, how much is other costing required. So that's which we can look around. That's quite crucial to look around. That will help to achieve the desired objective of the organization. Expense, yes, we want to be make sure the expense we can minimize and maximize our profit. So prime cost is the cost, is also known as a direct cost, which is consist of direct material and direct labor. Anybody any question, please? Yes, no question. Let's move to the next. Okay, so what we can do when we looking the cost of an individual unit, this is called unit cost. So every unit, every activity, every order, we can, how much direct material will be required for that, how much labor will be directly involved in the process, any other direct expense like a packaging and others, yes, maybe electric directly being used. So that's known as a prime cost. The prime cost is the cost that directly involved, also known as a direct cost, which is the cost is that traceable within the product. Then we have a production. Good morning. Then we can look around the production overheads. Good morning, Osama. You okay? Hope so you can hear me. So we can look around the production overhead cost, the cost which is directly not involved in the production process, but it's a cost, like accountant fees, like maybe you do advertising fees, and maybe you think about, like patents, copyrights, these all can be involved. Production overhead, then if we add them, we can say the production cost. Then we have other costs, which is non-production. Good morning.
Good morning.
Can you hear me? Okay. How you keeping? You okay?
Yes. Thank you. Yes, thank you. Sorry for being late.
No, that's fine. Thanks for joining us. So today's our key topic is the casting. Yes, we're looking LO1 and which will carry on. I'll do a recap. Okay, so uh, we're looking the direct cost, the direct material, direct labor, any other direct expense which involve in the production. So we call them direct cost. Direct cost, also known as the prime cost, is the cost which is traced within the product that's known as a direct cost. Then we have overhead is indirect cost that's not directly involved but is still incurred, so that we can include, and then we add them all. We can say our production cost, how much cost we to produce the unit. Sometimes we have a non-production cost overhead like selling and distribution cost, administration cost, and the finance department cost. That's is non-production. When we add them all, so we can say what is my total cost for any project or any unit, whichever in term of depends type of organization. So we look at these costing. Okay, so different, these are all the costing methods we use in cost accounting in the financial management perspective. You can do the batch. If I'll make the batch of 100 what will cost me? Absorption costing, the word absorb means direct indirect cost. You like, maybe we are paying end of the year accountant fees, but that cost we have to observe in the product, and we'll see how much is actual costing. If you work for your own business, yes, you have to absorb that cost into, because if you work for someone else, you get the salary. Because a lot of people make mistake, the reason they say, oh, my business on this profit, but actually they're not including their salary. Because you're working for your own business, it means you should draw the salary. Because if you work for someone else, then you can decide the right price as well for your product. Job costing, like manufacturers, builders, especially, they have a different jobs, like extend house, build house. So different jobs we do different costing. So job A, how much cost? Job B, how much cost? So marginal cost, the word marginal means the additional cost of every successive unit. Any additional unit we produce, how much will be cost? Okay, in, let's say if we making the table have various processes. Maybe we cut the wood, we buy the wood, we join, we polish, we pack, and then we sell the table. So this is all is called process one, process two, process. So one process cost, and other process is a material, then adding their services in a way, and then the labors, and then they goes to the third process. So each process we can calculate how much is the cost, because we can plan the things where we have a high cost, where we have a low cost, and is there any problem in the efficiency. That's which we can look around in the management perspective. Okay, any question, Sama? If you want to ask, please feel free. Always ask. You can
No,
stop.
it's fine. It's fine. The screen is not moving. It's empty page.
Oh, sorry. Can you see now?
Yes, now, yes.
Oh, maybe they not be. Okay, I was discussing about batch casting,
No,
in
it's fine. It's okay. Okay. Yes.
absorption casting, job casting, marginal casting, and process casting. Now we're looking production cost, the cost which is related to the production, as the word indicate, administrative cost, admin cost, sale and distribution, and financing. Like if we borrow money, if we overdraft, and how much cost us daily, really we need to. Direct cost, which is directly involved, but also known as a prime cost, and an indirect cost that's not directly the part of the product, but it's indirectly costing us. Yeah. So that's known as indirect cost. Okay. Direct cost can be coded and appropriate job and the client receipt. Indirect costs are initially allocated, appropriate cost centers, and allocation. We do different bases of allocation. Like you're living in the shared accommodation, and everyone's saying we share equal rent. But with respect, maybe I'm living in, are you living in the small room, and other your family or the friends living in the big room, and they're saying shade equally. We can say, come on, that's not a right criteria. You're giving me small room and you are asking me the equal rent. So what do we need to do? We can measure the area, whole house area, square foot or square meter, how much is the area, We can do the cost divided by the area. That's per square meter, per square foot area's cost, times by how much area I occupied. Then we can say how much is the cost. Yes. So we can do the costing according to the area, because that's, everyone. So we can allocate the cost accordingly. Okay. Level of activities, number of unit to be produced, we can do on the basis of value and items sold, number of units sold, number of invoices issued, and we look the cost behavior. Cost behaviors mean if the volume go up, if the production go up, the cost go up. Like a variable cost, the fixed cost will stay the same. So it's a crucial in the costing. We know the cost behavior. Variable cost, the cost change. Like if your gas electricity is the variable cost, if you use more, you will pay more bills. But your rent is a fixed cost, doesn't matter you one person live or few people living. Fixed cost, the cost stay the same for certain period of time. Fixed not mean not forever. It can be for 1 year, like a rent, rates, council tax. These are can be fixed costs. Semi-variable. Semi-variables mean the fixed and variable costs together in a product. Like you have a IT contract and you pay every month fees to IT company, but every time if you raise any IT ticket, you have to pay the cost. That's the variable cost. So we have a fixed and variable cost together, that's known as semi-variable. So we can use the high and low method, which we'll go through in the next slide. So that will help, we can differentiate how much fixed, how much variable. As the word indicates, step cost, step fixed cost. Like you produce 100 units and you have a capacity of 100 units. So that's your fixed cost up to 100. But if you have 120 units to produce, you have to hire new machine. So you're moving to the next step cost, next fixed step cost. That's known as as a stair, you go many steps, huh? But each step is the same distance in the cost. Why? So the distance wise as example. So fixed cost, it can be shown in the graph. Fixed cost, the straight line. Step cost is mean, it's a fix up to that point and moving around. So that is step fixed cost. Okay, as we mentioned, indirect cost earlier, level, fixed, variable cost. Sorry. Okay, so variable cost, the cost change, it goes upward. If I produce more, its cost is increasing and my total cost will go up. Semi-variable, which is fixed and variable together, is total cost going up. Okay, so please, when we use semi-variable, I want to differentiate high and low cost. How much? Step one, identify how much high unit of output and the low unit of output. And we looked at their cost. Like, I produce 100 unit, what is the cost? And I produce 1,000 unit, what is the total cost of the 1,000? Then I use the formula and I can calculate the cost. Let's, what is the formula? High cost minus low cost. High cost minus low cost divided by high output minus low output. So if we look here, high activity is 10,000 unit to produce and the total cost me 4,000 pounds. If I produce 2,000 units, it costs me 1,600 pounds. So now I do 4,000 minus 1,600, the difference between high and low cost. Okay, always we divide cost divided by activity. Some people put activity divided by cost. That's the wrong way. Always the pound sign, we do the costing, how much, this pack costs you and how many units within the pack. Like, so we can find per unit. So the total cost divided by 8,000 is our production. So is 0.3 is my variable cost. The cost I calculated by using this is a variable. So what is meant by fixed? Fixed is mean the cost stay the same. Okay, so if is your 0.3 is your variable cost, if I'm producing 4,000, my cost is 4,000 for 1,000 units. Sorry, 10,000 unit in this case. Huh? So 10,000 times 0.3, that make me 3,000. So my total TC, total cost was 4,000. 4,000 minus 3,000, which is a variable. What left? 1,000. So 1,000 is a fixed cost. So if I look on 2,000, it should be, my answer will be, if I'll do 2,000 times 0.3. Yes, so you have to, you've been given 1,600. So if you do 1600 times 2000 times 0.3 is come 600. So 1600 minus 600, what will be your answer is 1000. So it doesn't matter you produce 10,000 unit or you produce 2000 unit, your fixed cost will be 1000. So it doesn't matter high level or the low level, in between these two, in these costs, both these costs 1000 is the fixed element. So remaining are variable cost, and if I look per unit is 0.3 per unit. Please, if any question, you can ask. Okay, so cost behavior, we can look on the period cost is the whole period. Product cost, each product, each elements, we can look around. Then we can do the inventory. Inventory means stock. We can decide how much is good to be, and allocation, expansion, apportionment. All these, we can allocate cost to different departments. So we have the cost center to home, like you have a production department, they have a budget and they have a cost. So we can look around there, how many units they produce, how much cost them. Service department like a marketing, sale return, customer service, their cost and their budget. We can look around general overhead. Some department, they don't have their own budget, but they work for other department like a admin. So we can look around administrative and the selling distribution department. These are the service department, and we can allocate the cost accordingly. A different method we can use, direct proportion as step down cost, like this department cost shift to the other department because on the basis of some proportion or some so then we look around. One of the method is called observation costing or absorption overhead rate. Absorption overhead rate mean what basis you absorb the cost into the product. So it can be unit of production, it can be labor hours and the machine hour. Three, really, we have to look around the business we are doing is more labor intensive or is it more machine? Yes, or is it more unit intensive? So we can allocate the cost and we use budgeted overhead. How much is the budgeted overhead? We have an indirect cost divided by the budgeted activity. So we can find what is timed by how many actually the unit we produce, so we can observe. Then we can see my estimate was the right as the absorption, what we did, and actually what we did. We under or overobserve, sometimes underestimate, or we use the word overestimate. So these are, we'll carry on using two methods. Okay. Two main types of the service provided by the company operating in the industry, service providing by the company service department. Intangible, like in the service department, service is the intangible, it's the instant, can't touch it, it's not tangible physical substance like building plant machinery. We can touch it, it's need required. Simultaneously, it's quickly perishable. Service can't be stored. It's the first impression is the last impression, and last impression is the first impression. So we have to be look around each step. Heterogeneity, it can't be expected exactly the same because sometimes your behavior and you're dealing with the client is a different behavior. So that can be, it can't be constant. So we have to draw some parameters. Unit cost measurement, we can look around canteen, how many meals we serve, what is per meal cost. Education, full-time student, how much fees and how much cost. Hospitality, patient day, hotel occupied bed per night with cost. Transport, how many tons, how many kilometers, just total cost divided by the number of service. So we can, in the measure of the unit cost, we can do on the basis of fee. Any question, Osama? If you have, please, welcome. Okay.
No, thank you.
Okay, next we're looking marginal cost. The cost of every successive unit is known as the marginal cost. Marginal cost is also, it's good to be look around. If you're producing more, what is the margin? Contribution, the word is sales price minus variable cost. How much cost me, how much I sold it, how much I bought it, difference. Normally we can call them contribution, or you can say simple is a gross profit. Sales minus cost is the difference is your contribution. So that's per unit contribution, and we can This normally we use break even. Break even is a point, no profit, no loss. So we'll go through and we'll calculate that. So that's, it's quite good to look around the break even point. In the marginal costing and absorption costing. Marginal cost is mean the costing method where we look all the variable costs and the fixed costs we can just include as a periodic cost in the production. We can say total 1 year's cost and per unit cost. That's, we can say what is the every additional unit variable cost and the production cost that was fixed for a whole year. That's, which we can, the variable cost. And then we can say what is your total marginal cost. So and what is about the closing inventory left. So under the absorption cost, mean you fix and variable cost absorbed in the opening inventory as well in the closing inventory of this. So under the absorption costing, the value of the closing inventory will be high. Under the marginal costing, absorption inventory will be that's quite a look less. Let's we look this. Okay, the another method we use, because these are all the costing method we are discussing. There is a lot of people first in first out. These are inventory evaluation methods. So if we look in this case, this is our inventory cost card. We purchase unit on the 28th November, December, and how much quantity we and how much per unit we paid. Yes, and how much is the total cost. If we'll say now, find first in, first out, last in, first out, and if we do on 11th December, we issued 350 units and contain on 11 to record the inventory balance after the issuing. We can look around these methods. One is called FCO. FCO is the average cost, and FIFO is the first in, first out cost. So then we can, these being figures being given, and we can move the figures and we can put in the columns. So I gave the answers in the next. So if we look FCO, so we can add them all these costs of the units like 4480, 5280, and 2708. If we add them, and then we can add them units 280, 320. Yes, that makes 700, 160, 760. We divide the cost and we can say what is the per unit cost. I'm issuing 350 times by average, which is found by dividing, and I can find my answers from it. Then first in, first out, the box we have first, that goes on this price. So 280 unit will go. I need to issue 70s from this box. So then will be remaining all these, we can, because of the remaining total. So you can find the issuing cost, and the balance will be the total minus issuing equal to, and that's the way we can calculate. Here, we already put in the figures. So it's good to look around for the sake of your own understanding about FCO, FIFO, first in, first out. And there is other method is last in, first out. Because, the perishable good you store in a way, first in, first out. Average costing. So these are different costing methods we can use for different organizations, and that's quite good to use. Okay, any question if you have, please you can ask. So in your time you can look around. The cost center means the center to whom we are charging these costs, they bearing the cost. The cost center calculate the cost, like human resource, warehouse, and all these departments, they have the cost center there. We look, and the revenue center, which is mean the sales, they bear the cost and the sales. Yes, the difference will be the profit. Investment center, then they have the revenue, they look the cost, revenue, and the investment. They investing the money into different projects, and we can calculate their return accordingly. Argument in the favor of favorable costing is the fixed cost is the observed the closing inventory values normally is a higher than, and we can appraise which method is best for you. Doesn't matter, all method has advantages and disadvantages. We can look around in the perspective of your argument of marginal costing. Well, I said marginal costing normally used for the short term decision making, and marginal cost is cost of excessive unit, and marginal cost variable cost, and the fixed cost will be treated as the periodic cost, and of course closing inventory values can be left. Sometimes we under and over observed, and we can look around these perspective in the marginal costing. Okay, Then please we look around enterprise financial management. So in the management perspective, tax accounting, financial accounting, and managerial accounting. When we say financial accounting, is related to the financial statement and the cost related. We can look around the tax, of course, tax, HMRC. We look around the performance, in how much we perform, what we budget, what is actual cost, the difference is a variance. What was the capacity? Have we worked according to the capacity, like how many beds we have in the hotel, how many beds being occupied, and how much is the capacity required. So that's which we managerial accounting help planning and decision making, and the non-financial data also will look the satisfaction of the staff, which ultimately directly indirectly linked to the financial as well. Okay, so please, when we looking all the important of the costing is a good financial management ability to identify, interpret the information. That's as a manager you can use for your own fitness for purpose. So any costing method, whichever reporting performance method you use, you have to look around your business. What is the best for you? Yes, because different models, different costing method like activity-based costing, like we discussed job costing, marginal costing, absorption costing. So you have to look around. Business model may be different. Direct business model, like Dell computer, they're taking order advance and selling throughout the world. So the costing is quite is because the cash is there holding advance and then deliver the goods. So that's you have to look around the business model which you use. What effect will be on the costing, materiality, and the cost effectiveness. How effective you are, how significant your business is. That's which we need to be looking at. Okay, then we have here we looking the marginal versus the absorption costing. When we'll say marginal, we said earlier is mean uh, variable cost, which we use, and the fixed cost or the production cost we use as a priority. So let's if we say now fix overhead rate. So we've been given in the question here, fixed cost is a 40,000 for 10,000 units we produce. So if we'll say per unit fixed cost is £4 per unit. And if we'll prepare the sale price we've been given 15 and the material cost as 4 and the other variable 2, what is my fixed cost per unit is 4. So if I'll say what is the full cost per unit, 4, 2, and 4 is £10 per unit, including all fixed and variable costs. So we can look around how many units budgeted production, 10,000 units, and we are expecting budgeted sale 8,000 units. So what will be 2,000 units will be left in stock. So 2,000 units times by 10. So what will be the value of the closing inventory? And if how many units we sold, £15 times 8,000 units we sold, and then 8,000 times 10. That's the unit that's cost us as a full cost. So we can use, so the profit will be effect from. So if we look here, the profit per unit, we look the £15 material is £4, variable is £2, and the fixed is £4. So profit under the absorption costing is £5. But when we look the absorption costing, is the marginal costing, sale is 15, material is 4, variable is 2. So contribution is £9 instead of £4. Then we minus the fixed cost 40,000. So we can say £9 times 8,000 units. Yes. And then we say total we minus 40,000 as a fixed cost, and we can see under which method is the profit is high. So you will see here on the next slide. So marginal, we sold it. What cost is, because the marginal we do only variables. So we have 72,000 fixed cost is. So our profit is 32,000 under this costing method. When we use the absorption costing method, so our cost of sales is 80,000. So our profit is 40,000. You will see there under the absorption costing, our profit is more. Why is more? Because under the closing inventory, we observe according to the £10 per unit, not £6 per unit. So our closing inventory value is more. So that's the reason is our absorption and the marginal costing and the basis of we can observe and we can use this for the costing purposes. So we have to be consistent in the costing process. Whichever method you use are to have the advantages and disadvantages, but as a manager, you can decide which one is the best for you. Any question there, Osama?
No, it's okay. Thank you.
Then we please, I included the link for you if you want to look around further, yes, which we access in the lot of resources on the Kaplan resource, but Kaplan is a publisher. If you Google it and just write, costing behaviors and Kaplan, you will find the chapter of the book, but I included the link here, which you can copy and paste the link. You can look around and you can read, and go through the things according. So today lesson, if I'll do recap of it. So today we discuss about costing. We discuss activity-based costing, marginal costing, absorption costing. We discuss about fixed cost, variable cost, semi-variable cost, and the step cost. We discuss about the direct cost mean directly involved in the production. We said you include overhead, then we can say the production cost. Then you minus non-production cost like selling, admin, and distribution. And then we can say what is your total cost, or we can find the total profit that way minus all the costs. And that's, these costing methods are useful, and it's depend the nature of the business which costing method is best for you. You can choose accordingly. And we discuss about, marginal and absorption costing, the profit under the absorption costing, as the example indicates, is a higher than the marginal costing. Marginal costing, we calculate all the variable cost per unit, and then we minus the total fixed cost at the periodic cost, and then we can see, but absorption costing, the closing inventory, absorb the fixed elements as well variable cost is also known as a full cost. So that's all from my end, and the next lesson will go through LO2, the unit contents and the specification, and everything is available on our Moodle page. Earlier, as at the start of the lesson, I mentioned you. So each lesson indicative contents is a given. Today we cover LO1, and the next lesson will go through LO2, which is about financial ratios, financial statements, and how we can prepare these. And the next third lesson will go through budget. Fourth lesson will go through long-term finances like borrowing money. In the short long term, what impact will be on the risk side. And the last lesson will go through appraisal method, investment appraisal. So these are the indicative content what we're supposed to be learned, and the recommended books and the websites are given, so it's good to use in your time. So yes, it's good to be look around if you can, before next lesson LO2, that will help, and that's all from my end. Any question?
Okay, thanks so much.
Thank you. Speak you next lesson.
No, thanks so much. Thank you. Thank you.
Thanks. Bye bye.
Okay, inshallah. Thank you.